Hello everyone, welcome back. Today I'm going to be talking about navigating through and avoiding IRS audits. Okay. Now my background is I've done about 25 years of accounting. I worked on audits of both individuals and corporations, and I myself was personally audited many years ago, and I basically I got through that with no problem. So basically, I'm gonna share with you guys some of the some of the things that as an accountant that I know that you guys don't know, which will help you plan and avoid audits. The first thing we're going to talk about is the situation that most of you guys have, where you work for an employer, okay, and you get a W-2 at the end of the year, or even if you work, let's say, for 2 or 3 employers, each of them is going to give you a W-2 that states your income, and they give a copy to you and they send a copy to the IRS, and basically the IRS knows what your income is, and basically that number ends up in your tax return. If you have, let's say, 3 W-2s, you add up all 3 W-2s, and the total ends up in your tax return as your on your income line. Okay. As far as your expenses, most of you are going to basically take the standard deduction. The IRS gives you a choice. You can either take the standard deduction, which is some made-up number that they just give you, or you can take an itemized deduction. Basically, you generally take whichever is higher. For most people, the itemized deduction will consist of mortgage interest and taxes like property taxes, city taxes, real estate taxes, that kind of thing. So that's going to be the situation for most people. You may have some additional business expenses in there that your employer did not compensate you for, so that would also end up in the itemized deductions. So again, you get a choice, either one or the other, standard or itemized, and most people take the standard deduction, and that's pretty cut and dry. I mean, if the IRS is going to question you on any of that, they're usually just going to send you a letter. It might be a case where you forgot to enter the information from one of your W-2s, or it might be a case where they might ask you for proof of just proof of the real estate taxes that you deducted, and they're usually not going to meet you face to face. That's all. That's the easy stuff. Okay. Now, some of you who are free, okay, you are self-employed. The difference there is that you guys have freed yourself. You no longer work for the machine. You are in a position where you get to tell the government how much money you make, okay, and you get to tell them what your expenses are, and you do your tax returns based on that. Okay, so basically the IRS more or less accepts whatever information you give them, since you don't have an employer to report that information for you. Okay, so basically the IRS likes to go to a third party to verify whatever information they get. So in the case where you're an employee, they go through your employer. All right. In the case where you are self-employed, they go to your bank. Okay. And the reason for that is that most of your business transactions are going to run through your bank. Most of the money that you're going to get is going to be deposited into your bank account. And most of the expenses, right, that you pay are going to come out of your bank account in the form of either some type of electronic payment or a check that you write. So the point is that everything goes through your bank statements. So for that reason, right, if the IRS is going to audit you, what they're going to say is, give me 12 months, give me your tax, not the tax, give me your bank statements. They're going to say, give me usually 14 months of bank statements. They're going to ask you for the 12-month period that they are auditing, and then they'll ask you for 1 month before that and 1 month after that, just because bank statements don't always begin and end on the first day and the last day of the month. Okay, so that's how the IRS is usually going to proceed with the audit. Okay, and this is important information for us because if we know that this is how the IRS is working, okay, we want to work the same way that they're working. Okay, so when somebody comes to me and they say, listen, I'm self-employed, they bring me a box of receipts. Okay, I say, great, take that box of receipts, throw it in the corner. I really don't want to look at it. Okay. Give me your bank statements, okay? Because all that shit that's in the receipts, right, in that box of receipts, is going to be in your bank statement. So I don't need to go through all those papers like trying to figure out all your income and expenses when I got everything in the bank statement. That's going to save you a lot of money. It's going to save me time. It's going to save you money. And the IRS is going to take the same approach. They don't want to look at that box of receipts. It's good to have it, but they don't, that's not what they want to work off of. They want to work off of your bank statements. So, as the accountant, I want to work the same way that they're working. I'm going to say, give me your bank statements, and I'm going to go through your bank statements, and basically any money going in is income, and then any money coming out is expenses, okay? So that's the IRS mentality, okay? Any money going in is income with exceptions, okay? They do allow for exceptions. Any money coming out can be expenses. Doesn't necessarily mean that it is expenses, but it can be expenses. But that's the starting point. Now, what do we mean by exceptions? For example, if you sold a car during the course of the year, okay, that's not income. Basically, you bought that car a couple of years ago, right? You bought, let's say you paid $20,000 for it, and now you're selling it for $10,000, right? So that $10,000 is, let's say it gets deposited into your bank account. Okay, that's not income, unless let's say if you were to sell that car for more than you bought it for, then actually the profit would be taxable. But in most cases, you're selling it for less than what you paid for. So that basically is just an exception. Okay, so you can have many situations like that. All those situations might be that somebody lent you money. There could be a couple of other situations. I'm not going to get into all the details of it, but it's important to understand that when they look at your bank statements, they're going to go through all that money that came in, and you have to be able to, to account for anything in there that's not income, because they're just going to look at it. They're going to go through the whole year. Okay, over the course of the year, you deposit, let's say $60,000. Yeah, $60,000 worth of revenue. Okay, then basically they look at the expenses. Or if you come to me as an accountant, I'm looking through those expenses, and I'm basically going through them. And I'm going to basically make some type of a spreadsheet, where I'm going to have, let's say, your utilities, your operating expenses, your cost of sales, and then, I'm going to total all that up, again, working off of your bank statements, and all that's going to eventually end up on the tax return. So you have your money going in, money going out, all that information's in the bank statement. And we're doing that because we know that that's how the IRS looks at it. So we want to look at it through the same lens that they are looking through it. Okay. Now you might tell me, hey, listen, I have some transactions here, some cash transactions that didn't go through the bank statement. Now I'm going to say, listen, put that on the side for a second. We're going to deal with that last. First, I want to deal with the stuff that the IRS can see, okay, because it's coming through your bank statement. And then at the end, I'll deal with the stuff that the IRS cannot see, okay? And then we're going to figure out, how that's going to, where that's going to go, and if it's going to go anywhere. All right, but that's important for you guys to know, okay? We deal with the stuff that we know that the IRS can see, and then at the end we deal with the stuff that we know they can't see. So you want to have that division. You want to be working off those bank statements. I keep saying it over and over again because I want you guys to really understand that that's how this system works. That's how the IRS works, okay? What else can we say? If you get an audit, right? If you get a letter for an audit, and it's anything other than just send us, a copy of your W-2 or send us a copy of the tax, of this tax that you pay, let's say a real estate tax. If they want to do a full-blown audit where they're asking for your bank statements, what you're going to do is you're going to go and you're going to hire an accountant, okay, or a lawyer to represent you, okay? And it'll cost you a little bit more money, okay? It might cost you some $500. It depends on how organized you are, but it'll usually cost you at least $500. But I want you guys to understand this, okay? When the IRS audited me, okay, I'm an accountant. Okay? I know just as much as they do, maybe even a little bit more, okay? I did not try and represent myself, okay? I went and I hired another accountant to represent me, okay? Because I don't want a fair fight. I don't want to be me the accountant versus the IRS. I want it to be me the accountant and another accountant versus the IRS. The fact of the matter is that I'm simply too close to the action, because it's it's personal, right? If they're auditing me, I might get emotional. Who knows? I want a middleman. I don't want the IRS coming directly to me and asking me questions about what's this expense or what's this revenue item. I want them to go ask my accountant, and then my accountant, will basically say, well, I need a couple of days to go find, talk to the client. Then he's going to come ask me. Think about it. I'll give my accountant the answer. Then he'll go back and he'll give it to the IRS. So I never want to give immediate answers, okay? I want that middleman. He's going to be the buffer. They're going to ask him. He's going to ask me. I always want that chain, okay? So that's important for you guys to understand. If you are self-employed, do not try and talk to the IRS on your own. Even if everything is above board, legit, it doesn't make a difference. If you're 100%, an angel, you still get somebody to represent you, because it is very easy for you to be, 100% legit above board and make yourself look bad, okay? Make yourself, it might be one word that you say, one misspoken word. It's very easy for you to make yourself look bad. And, it's just like if you're involved, in some type of, let's say somebody breaks into your home and you're involved in some type of self-defense situation. You never talk to the police on your own. You always get a lawyer to represent you. Even if you are a lawyer, all right, you still get another lawyer to represent you. So that doesn't change here. Most of us who are, in the gun community, we're aware that we always get a lawyer to talk to the police for us. Okay, and the same thing applies with IRS audits or state audits or just audits in general. We never try and handle the audit on our own. We always get somebody else to represent us, and we have that buffer, that middleman, so that things will be a lot easier for you, and your chance of being successful will be guaranteed that way, okay, or come much closer to being guaranteed than if you try to represent yourself. Thanks for watching. We'll talk next time.